So today we'll do one quick final run through on the asbestos, just going through the class notes, make sure we didn't miss something from our previous class, and then a quick run through workers' compensation. I'm not going to do a detail on workers' compensation, but hit high enough level so you understand this product, and then if we have time we'll get started on the P&C insurance pricing, which is the big math problem for the second exam. So on page 47 or 48 of the notes, a quick summary. So I've given you a summary of what we saw in the asbestos. Widely used, we talked about, as much as 10% of the U.S. population had some exposure, important exposure, many lawsuits, and just like we saw with mold, we're seeing a lot of lawsuits even though there's some question about the actual injury, that there's people filing claims that have no medical issues whatsoever. The long latency periods is extremely important with this. It's one of the real challenges that you see in property and casualty insurance, especially on the commercial side, that you just do not see in any other type of insurance. So the claims, the amount of cancer stayed about constant, but suits for non-malignancies jumped dramatically. So we're seeing some incentive here related to lawyers and what they're getting out of this. Remember, I kept emphasizing the key to this are those class action lawsuits. So small claims are being overpaid, large claims are being fought, and then 9 out of 10 are these non-malignancies. And so 2/3 of the dollars are going there. So again, this is something legislators get involved with because they can see the most injured people are getting the least relative to their claims, and the least injured are getting the most, just because the volume of the claims is just the people being sued just cannot look in detail at that many lawsuits. So the number of lawsuits exploded from 21,000 to 600,000. That was as of 2003. So this is a 20-year ago problem. And several companies are being sued. Analysts predicting litigation of $1 billion, and then they said maybe it's $38 billion. And so now then they're saying 210. I think the 210 billion has actually come down. I've not seen an estimate here recently. I do know CNA is an insurance company, has a large asbestos exposure. That's the firm that Warren Buffett actually bought some of that exposure. There were several years there in a row where the CNA's CFO would come out and say, we had to add another several $100 million to our reserves, but we got it now. This year it's right. You won't see that happen again next year. And then the next year it would happen again. And the stock market just got used to these guys coming in every year saying, whoops, we've got to add another several $100 million to our asbestos reserves. So the incentive for the trial bar members is you had so many claimants that they had a big windfall. The lawyers, even though the claimants individually may not be getting that much, they also had people doing the screening that could be some fraudulence there. I'm not saying that the lawyers intentionally got the screening process to lie, but they found a screening process that definitely was consistent with their goal and how many claimants they wanted. And so I talked, I think this is pretty incredible. When you had someone not affiliated with the lawyers, they only found 4.5% abnormalities, versus the lawyer screening process was finding 96%. So there's obviously something here, and that's what that Judge Jack, what she was really responding to is, hey, this is not about people's health and compensating people. This is about making money for the lawyers. We talked about the fact that people were coming with both of these diseases. They're essentially collecting from two different places, even though it's extremely rare for someone to have both of those. So more than 50% of the Silica claimants also filed asbestos claims. So here's Judge Jack. She says these diagnoses were driven neither by health nor just as they were manufactured for money. Going after other parties. So you think you would go after people who actually produce asbestos, but they're going after anyone. They can't go after the asbestos producers because they're out of business. So then the costs really shift to the insurance industry, because even though their policyholders may be insolvent, they still have to pay those claims. So it's, they're still on the hook. They can't say, hey, my policyholder is insolvent, so we'll stop paying these claims. No, the creditors of the insured can still get money from the insurance company. Before Judge Jack, judges were not looking at the science, not really asking, do these claimants really deserve any kind of compensation? Have they really been injured health-wise? We talk about the difficulty here when you have this long latency period. Who is at fault? So the key for the claimants, what they had to prove first is that they had exposure to asbestos, and secondly that they had the cancer. They did not have to prove which exposure caused them to have cancer, and in fact, if they had 3 different jobs, they could sue all 3 of those. So, or here you say a single claimant files suit against 60 or more defendants. So, it's you don't have to prove who got you sick. All you have to do is prove you had the exposure at some time, no matter how many times you got exposed. You got exposed at least once, and now you have the cancer. And so it's just going to be assumed that one of those exposures gave you the cancer. And so all of those people are going to have to pay you, because none of them can prove that your exposure to them was not the cause of the cancer. And in this, it's pretty amazing me. Only 41% of the total spending on all of these claims went to the people who actually had injuries. 69%, or 59% is going to lawyers and to the firm's lawyers, and yeah. So what are solutions? Well, Judge Jack says we need medical evidence that someone's actually has health issues, and we're going to limit punitive damages. So Judge Jack's decision is likely to lead to higher medical evidentiary standards, might lead to fewer mass settlements. That was the other thing, is let's put a cap on these class action lawsuits. No more jurisdiction shopping. The need for scientific backing for claims made based entirely on exposure to the chemical without medical issues. So people were just saying, hey, I had exposure to asbestos, so give me some money. The federal government got involved with legislation establishing a no-fault trust, so people with exposure could be compensated. Now the nice thing about no-fault trust is that really eliminates those punitive damages, because you can make payments without admitting fault, that you were negligent, and that gets money to the people without all these extra lawsuits trying to get the lottery type of payoff. Several states have passed legislation that requires claimants to satisfy medical criteria. And the goal of all of this legislation is, let's compensate the people who've really been harmed, and stop compensating the lawyers, and stop compensating people who simply had exposure to asbestos but have no medical in the evidence of being harmed. So this was the solution. So again, just like with mold, just like with storm surge, these were major issues that hit this industry. It looks like it got resolved, but you can see there was a lot of pain on the way. So what I can't tell you is what is going to be the next major crisis that hits this industry, but it will probably be something along these lines of people wanting compensation, seeing the insurance industry there, trial lawyers coming in and figuring out ways to reinterpret policies, or to find the deep pockets of the insurance companies. So there's a lot of incentive, because insurance companies have billions and billions and billions of dollars. There's a lot of incentive to find ways to get their hands on this industry's money. So the solution: make sure it's an individual process, that you have medical proof of injury, eliminate the venue shopping, make sure people who are just innocent sellers, that we don't start suing everybody just because they have any connection whatsoever to asbestos. So make sure there's true negligence there. So the goal of the courts is not just to compensate people. The goal of the courts is to compensate people for other people's negligence. If they were not negligent, they shouldn't have to pay. And then there needs to be some statute of limitations based on manifestation, not exposure. So there shouldn't be a statute of limitation on exposure. But once someone realizes that they're sick, once they have that information, then there's a statute of limitations of how quickly you need to file a claim. So in some of these articles, we've seen the word ultimate. We're going to talk about ultimate more when we talk about Schedule P. I really love getting into Schedule P because it's so interesting. But ultimate just means what they've paid to date plus anything else they think they're going to pay. So we talked about reserves. Reserves are simply what you ultimately think you're going to pay in total minus what you've paid to date. And we'll see that when we do Schedule B. Incurred is paid plus the change in the reserve. So incurred is an annual number. So the ultimate's the total. It's everything you've paid to date plus your total reserves. The incurred claim is just for this year. So how much did you pay this year plus the change in that reserve? And we'll see that as well. And so, this gets back to Warren Buffett's article that we read early in the semester. Should we be discounting these? Especially with this long latency. If you have a latency of 20, 30 years, discounting something for 20, 30 years is going to make it much, much, much smaller. Maybe drop it more than in half. Or do you admit the fact, like Warren Buffett said, that, wow, every year we're increasing these claims, these reserves so dramatically, then why discount them? Because we're always adjusting them up. So, that's somewhat of a debate. I think reserves should be discounted. If you've got a, paid plus ultimate, the ultimate's going out 15, 20, 30 years, then the time value money, 30 years out with inflation, you should be able to put that on your books in today's dollars. That just makes sense to me. So to Warren Buffett's point of, but reserves are probably inadequate, we're going to see with Allstate that, with Allstate they don't look inadequate. It looks like Allstate set up the right amount. With CNA, with their asbestos exposure, Allstate doesn't have asbestos, but CNA does. Their reserves were inadequate for several years as they kept getting new and new information. But to me, the solution to reserves being inadequate is for firms to reserve better. It's not to say, hey, let's just randomly not discount them so that maybe the overstatement because we don't discount will offset the understatement because our reserving process is not accurate. To me, it's you should do your best with the information you have. And so you that actuarial science majors, this is a big issue. I worked real closely with the reserve actuary at UTSA. Just really loved working with her. She's very strong in the math and how she did things. Very, very quite the stickler for doing things according to the math, based on what we know. So it's not like, let me overstate it or understate it. I'm going to overstate it, just so we have some cushion in future years. Or I'm going to understate it so we have a better year this year. Her approach was, what do we know? What do we believe? That is what we will reserve based on the history we have. All right, so we'll talk more about the incurred and the ultimate as we get into Schedule P. All right, so that's it for commercial insurance. You saw the special issues with professional liability and the need for tort reform. The issue of asbestos, where you have one industry that's just huge, huge claims, and the need to reform the legal systems so as to pull back on the overcompensation for people who had no injury. These are the issues the insurance industry deals with. Now let's get into a whole new product. I am not a workers' comp expert. I did at USAA, there was a point where I actually went and worked in the risk management department that did all the workers' compensation at USAA. I was only there for 1 week because I went there, and as soon as I went there, my boss from my previous department, he wanted to go back to his old job, and he was told he couldn't go back to his old job unless I went back and took the department from him, which I was more than happy to do. And so all that happened. I took this job in risk management, was working there a week, and then at the end of the week they said you have to come back to your old job. But you say a week, that's not much experience, but in that week I saw a lot of workers' comp. It was a huge part of the insurance issues for USAA. It was the highest volume. And at that time, it was right in the middle. I don't know if you're familiar with the term carpal tunnel, but people who have repetitive motion issues, that was a huge thing at that point because of computers and typing. People were really having a lot of problems with their wrists and their arms, and it was causing huge workers' comp claims and disability claims. I just saw that, in fact, USA had a guy who was a hand expert. I mean, that was his thing. And I've actually been to a hand expert when I injured my left hand. There are people, because our hands are key to our employment, our ability to work. And that's what workers' comp is addressing. Someone who's been injured on the job and can no longer work. And so carpal tunnel was a huge one. It looks like that, just with all these issues we bring up, that one's been addressed and you don't hear that as much. They've gotten much better at designing workspaces and keyboards. It was frustrating to me because they reworked workspaces so much that they made the workspace perfect to the person who worked there. And so it made it really difficult if you needed to go to someone else's area and you needed to real quickly just click on someone's machine. You sit down at your desk and suddenly you're either way too high or way too low. So it didn't work really well allowing you to share other people's desk, but it seemed to have addressed that issue. But that was my week of seeing workers' comp and just seeing over and over again this one crisis that hit the industry all at once there. So let's talk about workers' comp. It's a very unique insurance. Every state has their own program. This is not a federal thing. This is a state by state by state thing. And so we're going to keep it very high level. It could be an interesting topic for paper 2, I think, because there are a lot of issues out there. We'll talk some in particular related to COVID. But let's talk about the history of this. So workers' comp is very different than any other insurance, and it has to do with the nature of work and U.S. competitiveness and trying to find a compromise. So initially, when we went into the Industrial Revolution, the work environment changed dramatically going into the industrial age. So the U.S. used to be 96% agriculture. We moved to, I don't know exactly what it is today, but 1-2%. In fact, the large corporate farms that we're starting to see may even reduce how many workers we have in farming. Farming's become a very older workforce. There are a lot of farmers in their 60s and 70s and 80s. They're having a tough time replacing them with younger farmers. And so it looks like we're moving more and more toward a big corporate farm. But that's farming. Farming, people say, well, we went from farming that was safe and we went to industrial age that was dangerous. I think if you look back at the data, it's the exact opposite. Working on the farm was actually quite dangerous. Not only that, but even after we had all these child labor laws, the child labor laws didn't affect kids working on farms. Parents could still work their kids on the farm. So it was a dangerous. Agriculture is a dangerous place. It's just that with agriculture, people are essentially self-insured. If something went wrong, someone had an accident, got injured, you just gutted it up. So the change is not that the workplace got more dangerous, in my opinion. Now you can certainly go research this. There's a lot of books written about this, obviously during the Teddy Roosevelt years. But I don't think industrial age jobs are more dangerous. There certainly were some, obviously coal mines and some industries were more dangerous. But there's a lot of industries that are much less dangerous than the farm. And so the key is not the change in the danger of the work, but rather the change in the pockets of the people hiring the workers. Instead of you working on a family farm, it's now a person is working for another employer or another company, and they have resources. But unfortunately, early on, the employers saw their employees essentially as having rights inferior to a complete stranger. And what that means is someone's working at a firm and they become injured in some accident, maybe something falls over, and maybe there was a customer at that same spot. So the customer walks in, something falls over, the employee gets injured, and the customer gets injured. Well, the customer can sue and be compensated, but the employee really couldn't do anything. First of all, if the employee sues and says, "Hey, I've been injured," the employer can threaten to sue them. Threaten to fire them. So if you threaten to sue, your employer says, "Hey, you're a bad employee. I'm going to let you go." Also, you might need some witnesses. Well, if your witnesses are other employees, they don't want to testify for you because they don't want to lose their job. And so, coming into the 20th century, especially under Teddy Roosevelt, government said, "Hey, we've got to increase the defenses for the employee." So the employer had these great defenses. They had the fellow servant rule, which they could say, we talked about this earlier, if there's any contributory negligence, that absolved the party from all negligence. So if the employer could just show, "Hey, yeah, this employee was injured on the job, but it was partly because of another employee that was negligent. So maybe we were partly negligent, but this other employee was also negligent, so we don't owe anything." And those were the rules back then. If you can just show someone else was also contributing to the negligence, then that absolved them. That's no longer true. We saw that with the McDonald's case, where the lady who spilled the coffee was 20% responsible. McDonald's was 80%, so they just split it between the two. But back in the 19th century, that was not the case. The other one is assumption of risk, which this is kind of the libertarian argument, is if the workspace is really, really dangerous, like a coal mine, well, employers, they should have to bear the risk for an unsafe workplace, because if the workplace is unsafe, the employees just won't work there. They won't be able to get anybody work. So the employers are going to set up a safer workplace, not because they're nice and they're worried about their employees. They're going to do it because that's the only way they can hire employees. So essentially it is, hey, if it's dangerous, they'll have to pay their employees more, or they'll spend the money making the workplace safer. The employee knows that, and so when the employee takes the job, they know they're getting paid more to take a dangerous job. Therefore, they shouldn't have the right to sue when they're injured. So that was the environment early on. And then the new environment was the employer was beginning to be required to provide a safe working place. And they have to warn about unsafe conditions. And if they didn't do that, the employee now had the right to sue, and the employer's defenses, the fellow servant rule and the assumption of risk, those defenses were being destroyed, and courts were finding more and more in agreement with the employee in their lawsuits. Well, now the employees are saying, okay, we're being sued left and right. Every time any minor cut, anyone gets injured, we're being sued. U.S. will no longer be competitive. What are we going to do? We're not going to be able to compete with Europe and Asia. We got all these employees because the U.S. had many more lawyers than any other country. Lawsuits were more common in the U.S. So this was this fear that all these employee lawsuits was just going to make the U.S. not be able to compete with the rest of the world. And so legislatures understood that at the state level, and so they came up with workers' comp, which is a compromise. We first saw this in 1911, and it took 30, almost 40 years for every state to pass workers' comp. And here's the compromise they came up with. It's kind of a strange compromise, but essentially what the state said is we're going to treat injuries on the job under the concept of strict liability. Now, what is strict liability? Strict liability means you're liable just because of the nature of the activity. There's no need. The most important thing is you do not have to prove negligence. Now, where do you see strict liability? Well, one of the most common places of strict liability is really dangerous activities, like people who use a lot of dynamite. Maybe in kind of the dirt mines, salt mines. You know, they have, you know, a lot of explosion because they're, you know, they're digging up dirt and whatever they're doing. That's a really dangerous thing. So if you use dynamite, it's part of your ongoing business, and someone's window breaks, you cause some damage to a house a few miles away, the person whose house was damaged, they don't have to prove that your firm was negligent. All they have to do is show that you used dynamite, it caused damage to the house, and they can sue and they'll win on strict liability. You might have followed all the rules, you didn't do anything negligent, everything was done exactly right, and still there is harm done to the house. They can still sue without having to prove negligence. So that's strict liability. Same thing with piano movers and other type of businesses where the nature of the business is just so risky. We're going to assume you're liable anytime there's damage. We're just going to throw away the responsibility for negligence, proving negligence. Now, why does that apply to workers' comp? Well, essentially, here's the compromise. The employee agrees not to sue the employer and gives up the right to general damages. In fact, the only damages they're going to get, according to these laws, is what the state says they'll get. The benefits are actually scheduled. So if you lose a hand, you'll get this much. If you lose a leg, you'll get this much. Whatever the damage is, the state will tell you what your award is. So there's no pain and suffering. There's no punitive damage. So the employer essentially says, hey, if an employee is injured on the job, we'll have to pay for their losses, even if we can prove we were not negligent. What the employee gives up is the right to sue and try to get pain and suffering and punitive awards. It's very administrative heavy. You'll hear commercials on the radio. I hear them all the time about Texas workers' comp and the various entities involved in that. So there are some issues about how this works in certain special cases. That's why I said there's a lot of very special issues to this. So what if an employee is injured on the job but using the product that the employer built? So let's say an employee works for Canon. Canon makes copiers. So an employee works for Canon and the Canon copier blows up. So the employee is injured on the job, but they were injured by a product built by Canon. In those cases, you'll see the strict liability compromise isn't always held. You'll see a lot of lawsuits related to workers' comp. So the thought was, well, if we do strict liability, we're not going to have these lawsuits anymore. But you still see a lot of lawsuits related to workers' comp. Starting around the 1980s, most states were seeing serious problems with their workers' comp systems, similar to what we were seeing about the same time with professional liability. Just a really high increase in severity and frequency. This was pre-corporate tunnel, so the corporate tunnel issue was somewhat of an issue, a decade or so after that, which just exacerbated that whole issue. It could have been the move to managed care, could have been the issue. So what was happening is a lot of healthcare was moving to managed care, and managed care wasn't making much money, so whoever wasn't on managed care, they were getting a lot of costs, healthcare costs shifted to them. And so a lot of people think, as most employers moved their healthcare for their employees to managed care, workers' comp was taking up the slack, and they were seeing huge increases. But whatever the case was, the 1980s was terrible for workers' comp. So workers' comp is not an insignificant amount of, I'm using numbers back from when, the last that I have data. I should probably update some of this data, but workers' comp, 1 or 2% of employee costs. The firms I've dealt with, that's about right. Workers' comp is not a huge expenditure in total. For smaller businesses, it can be an issue because one claim can have a huge impact on their future premiums. It is skewed by industry, though, no question. Workers' comp is really important in the construction industry. Not as important on the service industry, but it's some of you are talking about doing the gig economy, or shared resources like Airbnb and Uber and Lyft and those type of things. Workers' comp becomes a big issue. What if an Uber driver is injured while transporting one of your riders? Who bears the insurance for that? So there's a lot of issues here with the gig economy. People who aren't officially employees, so states are trying to require firms like Uber to actually provide workers' comp and other employee benefits to these employees. So let's talk about that. So where are we? Where is workers' comp? So this is still all accurate. It may vary a little bit by state, from state to state, but it's still accurate. So workers' comp covers all employees unless excluded. So there are some that are specifically excluded by certain states. In fact, anytime you walk into a business as an employee, I know this at this private school I was working at, you will have the state mandated workers' comp sign. Now, I know at UTSA I walked into their coffee room and they had that workers' comp sign up, except for the sign had two sides. One side clearly says, do not show this side, show the other side, and that was the detail for the employer. That's the side UTSA had put out. So whoever put that up failed to read which side they were supposed to put up. But there are required notifications that you have to put up. Who's covered, who's not covered, how to file claims, those type of things. There are business size requirements. So very small businesses are exempt. Agriculture is still exempt. So agriculture is, for the most part, self-insured. Casual work, and that's maybe where a lot of the gig economy is. So there's a lot of interesting issues with workers' comp. What exactly does it cover? It covers accidents arising out of and in the course of employment. And right there creates a lot of issues. What does arising out of mean? What is in the course of? If you're on break, are you employed or not? If you're getting up to go on break and something happens, at what point does it happen? What if you're driving into work and you're talking to your boss on your cell phone? You could even be hands-free, you're obeying the law. What if your boss requires you to talk to them every morning on your drive into work? You have to do it. It's like a mandatory. My boss, my word, I had a boss at a time that he was just, oh man, the second he got up, he was on his cell phone talking to us. And I was already at work, but he was just talking to us constantly, getting in his car, driving in. It was irritating to us because he'd have us on the phone for 30, 40 minutes. And it's just like, oh, give me a break. But what would happen if he got injured while talking on his phone on the way to work? So, this is a big issue. Rising out of in the course of employment. It covers occupational disease like asbestos that may not manifest itself for many, many years. And you may have a tough time telling, as we talked about before, which employer actually was the cause of the illness. So it does cover occupational diseases, not just injuries. Now what's not covered, now this is going to vary by states. So if the employee is intoxicated, you're away from work, again, what exactly does that mean? The heart attacks on the job, I know there's been some challenge to this. If someone said I had a heart attack on the job because of the stress of the job, workers' comp generally does not cover that, but I know there's been some debate on that. I do remember at UTSA a gentleman had a heart attack, and the workers' comp people, they were adamant about who showed up first, what did they say, how quickly was 911 called. They're worried about the man's health, but they also were worried about UTSA's process and making sure was he taken care of. So there's always, firms should always be looking at, every time something happens, looking to see, did they do the right things, how well was it handled. Here I'll mention on coffee breaks. If you're on coffee break and you get injured, that's not workers' comp. Injuries during transport to and from work, but again, You know, I think about autonomous vehicles. We may actually be having our staff meetings on our drive to work. We won't be driving, and then we get injured. Was that part of work? I think then you'd have to say, yeah, that's you're at work. That's, you're doing work-related things. Injuries caused by horseplay between employees. So there are things that are excluded. It varies by state to state. One thing I didn't put in here that was a huge issue in California, I don't know how they resolved it, but they did cover mental illness as one thing that workers' comp would cover. So you kind of see heart attacks not covered because you don't know if the job causes stress or maybe in family history. And so the same issue with mental illness, how can workers comp handle mental illness? And it was that same argument, the stress of the job or the nature of the job caused that. What happened in California, because mental illness treatments can be really expensive, is that people are actually taking jobs so they could file claims under workers' comp and have that covered. So it caused a huge increase in the claims, kind of an unintended consequence. So every state has their own rules, and it can cause really very major differences between states. So what actually will you get if something happens? There are morale and moral hazard issues. Insurance companies say, you know what, an employee doesn't like their job. They would sure love to get injured on the job, maybe not seriously, but injured enough so that they can stay home and get paid and not have to come to work. You know, if you got a really horrible job that you just hate, then, you know, getting injured on the job might not be so bad. And then you have the moral hazard, which is someone pretends to be injured when they're really not, and that's illegal. You can go to jail for that. That's the moral hazard. But the moral hazard is, hey, I won't be all that safe at work because if I get injured, then, you know, great, I get paid for staying home. Moral hazard is I'm going to pretend like I've been injured. So there is coordination of payment. The one thing with workers' comp is they don't want someone to have so many different coverages: health insurance, disability insurance, workers' comp. You put all those together and you end up getting 300 times pay, 300% times paid. So 3 times paid, and then they have a real incentive. So workers' comp will coordinate against these other insurance coverages. Usually workers' comp is going to be primary coverage. We talked about this earlier. Auto insurance will exclude coverage if workers' comp covers it. So if you look in your auto insurance, workers' comp is one of those exclusions. If you were injured on the job, then workers' comp will cover it. Auto insurance will not cover it. It covers your medical. So again, here we have another policy that covers health care. But workers' comp will be primary. Your health care will be secondary, depending on how you have your auto insurance. So you can see how complicated this could be. You're driving for work and you get injured, and now you have 3 policies. You have your auto insurance, you have your health insurance, and you have workers' comp. And so now the question is, which of those 3 is going to cover you? And you may have a big battle between the 3 of them trying to figure that out. It does give you disability income. Now, firms also provide disability income. So you might say, you know, I'm injured, I can't work. Why do I care if I were injured on the job or injured away from the job? Because if workers' comp covers it, that's fine. If workers' comp doesn't cover it, my firm's disability insurance will cover it. But there are things you would definitely want to look. You know, usually if workers' comp covers it, you want to go under workers' comp. But you know, that's one of the questions you have to look at and kind of understand, especially because disability usually doesn't cover as quickly as workers' comp, and so you may have a lockout period where you're not getting any coverage. If it covers disability, that can be temporary disability or permanent disability, and the permanent disability can be total disability, they can't do anything, or partial disability, they can do some work but they can't get back to 100%. So temporary, they'll essentially get back to 100%. Permanent is they'll never be able to work again. And there are people, I remember looking at workers' comp when I was that 1 week in that job, there were people that had been on workers' comp for decades. They may have gone on workers' comp in their 20s and they were still on it in their 40s and 50s and 60s. And carpal tunnel I know some people that was total disability. Court reporters that sit there typing all day long, some of them had such serious carpal tunnel they really could not do any other job. Certain things, it seems a little morbid, but there are certain things where they say, hey, if you lose a certain type of limb, you'll get this much coverage. That seems a little unfair because a loss of a leg for an accountant is very different than the loss of a leg for a construction worker. But, you know, so the laws, it's kind of tough when the law is actually dictating, here's the rules, and they have to somehow apply to workers in all these different industries. You can see how workers' comp at the state level, the legislation can be quite complicated. Death benefits, funeral expenses, survivorship benefits, and then rehab. We'll talk about rehabilitation benefits. It's a big one because the employer wants the worker to come back to work, so they don't pay them an income when they're not doing any work for them. So rehabilitation, how can you get the employee to actually want to get better, be able to get back on the job? Now this is probably out of date, but this was the case when I did these class notes. Security arrangements, yes. There are states that have monopoly run type of workers' comp insurance, so you can only use the state's program. There's some states that have their own state workers' comp, but they allow competitiveness. Most states will allow self-insurance depending on the size of the employer and if they have the wherewithal to be able to do that, so you don't have to necessarily hire an insurance company to do it. But remember, you know, workers' comp is a very specialized insurance. There are advantages of having an insurance company to work with. USAA used an insurance company, not so much to cover the cost, because, you know, workers' comp is a fairly predictable, other than things like carpal tunnel, but fairly predictable amount. And when you bring a third party in, it can't save you money. If you know you're going to spend $10 million on average every year, remember the insurance company is going to charge you $10 million plus expenses plus profit. So if you know on average you spend $10 million, then the insurance company is probably going to charge you $12 to $13 million. So on average you'll come out behind. So you hire the insurance company not to save you money, but mainly to help you manage the claims because they have that expertise. And I definitely saw that at USAA. All right, so I want to finish up workers' comp. I mean, it's essentially disability, health and health insurance, a little bit of life insurance. It kind of covers all these different types of insurance on the personal level. So fairly straightforward. We don't talk disability insurance in this class. It's more the life insurance side, but it's, you know, it's, you get income if you're injured. Disability insurance covers you, gives you income if you're injured, whether you're injured on the job or away from the job. Workers' comp is specific for injuries on the job. So it's an insurance that's important. You may not care if you're covered by workers' comp or covered by disability. They may seem exactly the same to you, but it is a unique insurance. Now, one thing you may be asking, why is workers' comp on the property and casualty side when disability insurance is on the life insurance industry side? And I really think it has to do with the customer. It's true workers' comp is mainly health insurance and disability, and both of those are on the life insurance side. But the customer for workers' comp is the corporation, it's businesses. Whereas health insurance and disability tend to be more individual type of insurance. So I think since the life side has individual insurance and group insurance, the property and casualty side has personal insurance and commercial insurance. And since the property and casualty side's already used to the commercial insurance, already used to dealing with businesses to sell them this package product, it made sense just to leave workers' comp in there. That's my idea. I don't know the actual history on that. But workers' comp's on the property and casualty side, disabilities on the life insurance side. I doubt from an actuarial standpoint there's a huge difference in the training for actuaries. That'd be my guess. It would be interesting. I used to do these presentations all over the country. I was talking about the property and casualty side, and there's a lady always on the same panel with me. The two of us did several presentations together. She was a workers' comp person, so it was interesting talking to her because I didn't have a strong background in workers' comp. So it's interesting just seeing what are the big issues hitting this industry. So let me give you a few of these. I've already mentioned the first one, medical costs. Higher medical costs, since workers' comp is predominantly medical costs. Workers' comp has moved to managed care. Now, the whole world is moving, is changing on healthcare. The Affordable Care Act certainly has some implications for workers' comp, but healthcare itself is under tremendous reform. If you take my life insurance class, we get into that in quite a bit of details, so I'll leave that there. But healthcare costs are a major issue for workers' comp. Loss control. I don't mean you lose control, but you control your losses. That means you're trying to reduce frequency and or severity. That's what we mean by loss control. So any attempts to reduce frequency or severity, that's what we mean by loss control. We're trying to control those losses to a more reasonable level. Workers' comp, as a big part of workers' comp is to try to encourage employers to be safer. So you may actually get lower premiums if you do that. And that's what I found so interesting that week I had at UTSA working on the risk management side, is how much the workers' comp insurance company, how much they were at UTSA. That 1 week I worked there was the week they were meeting with their workers' comp insurance company, and they were a consultant. We talked about this earlier. We said companies shouldn't buy insurance because of cap-in, but many of them do, and one of the reasons is insurance companies are really good at managing these risks. And so you may be paying for the insurance, an extra $2 million for the insurance may end up saving you $3 or $4 million in employees being injured and lost productivity and all those kind of things. So you may get better ratings from the insurance company, get a lower cost. So you can use the cost of the insurance to actually get better loss control. There could actually be a cost-benefit analysis. If we incorporate this procedure in our company, it will cost us $100,000, but we'll see our workers' comp insurance come down $200,000. The problem with that is smaller companies don't get much experience ratings. If a company only has 15, 20, 30 employees, implementing these type of loss controls will typically not have any impact at all on their premiums, and that's because their premiums are based on just other companies of their size. They don't have time. The insurance company doesn't have time. The private school I dealt with had about 20 employees. The insurance company really doesn't have time to sit down and say, hey, here's the risk that you're taking. You need to change your process. And there is some problem even for larger employers who probably could get a break on their premiums if they exercise loss control. There is some politics to this. We'll talk a little bit about that when we talk about auto insurance pricing. There is some politics. The political process causes insurance companies to charge in ways that are not consistent with good actuarial science. We've already raised this issue. What do we mean by arising out of and in the course? So I talked about mental illness, stress-related issues with heart. How do you show that the job is what caused this versus what's going on at home? We've already talked about asbestos. When were they exposed and how do we prove that? There was a lawsuit. I did look this up. It was an interesting lawsuit, but some flight attendants, it's hard to believe they used to allow people to smoke on planes. And several flight attendants actually had a lawsuit where they were suing because of getting cancer because of all the secondhand smoke. Now, what was that lawsuit? This lawsuit was actually against the tobacco industry, but they could have sued under workers' comp as well because their employer required them to work in this closed environment where there's all this smoke. And I have flown, I'm old enough that I flew at a time where they allowed smoking on planes. And I'm very, very sensitive, especially my eyes, very sensitive to cigarette smoke. So I realize people that are chain smokers, a 5-hour flight can be quite a horrible thing. But for me, people that don't smoke, a flight with smoke on it was pretty tough. So these flight attendants, I don't know how much medical evidence they had that flight attendants were more likely to get lung cancer than a typical person, and that they could tie that back. But I could see that as a workers' comp claim. Sometimes workers' comp will pay claims even though it doesn't quite fit exactly what the state law says. The courts will say, you know what, workers' comp, it's not technically a workers' comp claim. However, this poor worker, this is terrible. Someone needs to take care of them. We'll just let the workers' comp place do it. That's part of what we talked about with mold and all these other things. Is courts look at it and say, you know what, we won't go by the letter of the law. We're going to reinterpret it like this. So there probably is some of that going on. Probably the biggest one that I think is the most interesting is the changing role of work. Obviously, people working from home, and that's going to be a huge one. I was reading an Economist article just yesterday talking about how people will probably, even if they come back from the lockdown, there will still be a large percent of workers who used to go to work 5 days a week and will probably work from home 1, 2, or even 3 days, and some 5 days a week. So that has changed, and that's going to have a huge impact on workers' comp. So again, for paper 2 topic, I'm sure there's a lot of articles on how work from home is changing workers' comp. Driving while talking to your boss. I have an article there about distracted drivers and benefits. Here's an article 10 years ago. A distracted driver was awarded workers' comp benefits for an accident that the claimant says was caused by her work-related cell phone. This was a nurse who had to be on call, and since she had to be on calls, even when she was driving, she had to be paying attention to her phone. This is a pager. You may not know what a pager was, but back when we had pagers, I guess we probably still have pagers. But she had to respond within 15 minutes. If she didn't respond, then she'd be called on her home phone. So this is, back when people had landlines and people had pagers, so it's a little bit different time. But the theory behind this case is pretty interesting, that she had to be on call, she had to be paying attention, and if she's on call and has to be paying attention, that means that getting a page from her employer could distract her as a driver. She can have a wreck. So she says she was driving home from work when her cell phone light caught her attention and caused her to glance down. She drove her car off the road. It resulted in her wrecking her vehicle and injuring herself. And so the court said, yeah, that is workers' comp. People who drive for work, that's becoming more common, especially we're talking about Uber and Lyft. And not just Uber and Lyft driving other people around, but more and more of this gig economy where people are driving food to people's houses. I have not used a home delivery food service other than pizza, so I'm not sure exactly who all these employees are. Pizza delivery people tend to be employees of the restaurant, but now we're seeing more and more people delivering food, delivering other items who aren't actually employees. They're their own employee, they're self-employed. We're seeing more and more partial retirements, so we've got baby boomers who want to retire, but they can't retire because they don't have enough money to retire, so they're going to go to 20 hours a week. That's going to put a lot of older people into businesses. We'll probably see a large increase in 65 and older workers, especially those who just cannot afford a retirement. And they have special issues, they get special injuries, and that's going to change workers' comp. The nature of the work itself, obviously keyboards was a thing in the 90s, that was a huge issue. But even just the changing work with Zoom. I don't know what kind of claims, workers' comp claims doing all these Zoom calls is doing, but I'm sure there's been one. And then autonomous vehicles, if that ever comes around, I think of this more of autonomous trucking, and if that happens, how could that change workers' comp? You might think, well, that's going to make it a lot better because we don't have people driving trucks. There won't be any employee there. But it's interesting. It's autonomous vehicles for us as individuals will still be in the cars, but who's responsible for that? Is it the software provider, the one who developed the car? Or if you're at work in a conference call and you get injured, who's going to cover that? So there's a lot of legal issues we got to work out that COVID-19 and autonomous vehicles and other things are certainly going to have an impact. Fraud is a big issue. I'll show you some fraud issues next video, just real quickly. They're easy to find. Just give you some real quick overview of these type of claims. There's a coalition against insurance fraud. I don't always trust these groups because they have an incentive to inflate the numbers. But they say there's tens of billions in false claims. People claiming they were injured on the job, and either they were injured away from the job. Maybe they were playing football in their neighborhood and they broke their wrist or broke an ankle, and so they got their buddies to drive them over to their workplace and shove them down the escalator so they could say they were injured on the job or whatever. There's people who the fraud is they say they were injured and they weren't really injured, and there's a lot of those. So here's some examples. They weren't really at work. They were at work, but they exaggerate the injury, or they fake the injury, or it's an old injury and they want to get compensation for that. Or they're fully recovered, they're ready to come back to work, but they don't want to, so they just pretend like the disability is still there. Now, abuse can be that the doctor orders extra tests just to make sure they're not still injured, and so that could certainly increase the cost. That is probably okay, because sometimes that's going to actually reduce costs, whatever. So here's a few videos. If we have time next session, I'll show you a couple of these. I think they're sad and sometimes comical. Now, there can be fraud from the employer standpoint, the actual insured, because the employees are not the insured. They're employees of the employer. The employer buys the insurance. So workers' comp, they need data on payroll, and that's how they set their rates. So the higher payroll, because a big part of workers' comp is disability insurance. Disability insurance is, if you make $50,000 a year, they're going to reimburse that employee based on that $50,000. So some employers will actually underreport their payroll. The employer might claim that the workers are more expensive than experienced than they actually are. Try to somehow say, hey, our employees are not that risky, they're very well trained, and they fail to obtain workers' compensation for their employees even though it's required by law, and so the workers are deceived thinking they have it. That to me is a big issue for some of the smaller firms, construction type businesses. So fraud is an issue. If we have time, we'll look at a couple of these just to give you some examples. We've already talked about claims administration, so essentially workers' comp becomes somewhat of an outsourcing exercise. The issue with claims administration is if the employer is not involved, it's this third-party insurance company, that may actually reduce the incentive for the employee to get back to work. If the employee doesn't sense that their employer really wants them back on the job, then that can be an issue. And there's a window of opportunity. You got to get an employee back to work within 6 months, or else they're going to get out of the habit of going to work. They may say, I'll just stay on workers' comp the rest of my life. If it's done internally, so if you're going to do everything yourself, it's not just a matter of, you might have a large employee base, and so you say, hey, we'll just manage it ourselves. We don't have to pay all the expenses and profit for the insurance company. Well, you got to realize there are some economies of scale, especially related to the specialized staffing like actuarial services. At UTSA did hire actuaries outside of their insurance business. They had an actuary related to their pension plan. They had an actuary related to their health insurance plan. They didn't have an actuary related to workers' comp. But if you're going to do everything yourself, you would have to hire those special services. So the ultimate goal is, if you're going to do it yourself, you probably have a better ability to get employees back to work, but you're going to have to spend a lot of money on essentially building everything the insurance company has. If you're going to use the insurance company, use their expertise, then you got to make sure you're still involved with the employees so they have an incentive to come back. 24-hour coverage, as I mentioned, workers' comp is overlaps with health insurance, disability insurance, all these other things. There has been a move. It's probably more pronounced outside of the U.S., but there has been a move. Let's just coordinate all this stuff. Why do we have health insurance and then disability insurance and workers' comp? Why don't we just coordinate them all together? And employers are starting to notice a little bit more. It's still separate insurance from the insurance industry standpoint. The employers start seeing it more from their standpoint, that all merged together. It's tough to merge these together because states regulate workers' comp, but ERISA is a federal agency that regulates compensation. So things like pension plans and those kind of things. So you got the federal government versus the state government, so it's really hard to coordinate these. And then the last thing is, how do we get employees back to the job? Especially those lower paid workers who really would prefer to be at home, getting compensated, or maybe they even take another job. So most workers' comp have some type of formal return to work programs, looking at the job, what can the employee do, match those, what the employee can do to the job requirements. That they mean they need to move to another type of job, that's fine. There may be rehabilitation services, and we'll pay for that. You may have to transfer the employee temporarily, and you really need to be working closely with the employee, so there's going to be some cost to that. So if the worker doesn't desire to return to work, then it may just fail. All right, so that's my quick run through workers' comp. We might do a little bit on some of the fraud side. Where we go next from here is pricing insurance. So get your calculators out for the next session. We'll be doing a lot of number crunching.